Imagine you need a new heart valve. 10 years ago, that meant cracking open your chest, stopping your heart, going on a bypass machine, and spending weeks in recovery. Today, a surgeon can thread a catheter through your femoral artery, up to your heart, and deploy a new valve, all while your heart is still beating. That is what Edwards Lifesciences built, and today they are telling us how the first quarter of 2026 went.
This is a company that has spent 2 decades turning minimally invasive heart valve replacement from an experimental procedure into the standard of care for hundreds of thousands of patients annually. And after a major portfolio transformation, this quarter is really the first clean read on whether the pure-play structural heart bet is paying off.
That is what we are diving into today: the numbers, the thesis, and the questions investors need answered. This is Charged Alpha. I am Hudson Thomas.
And I am Lana Chen. Let's get into it.
So Edwards Lifesciences was founded in 1958 by Miles Edwards, a mechanical engineer who had a simple but radical idea: build a better heart valve. The company is headquartered in Irvine, California, and today employs about 15,800 people globally. It is listed on the NYSE under the ticker EW, and the current CEO is Bernard Zovighian, who took over in January 2023 after the company's longtime leader, Michael Musallam, stepped down.
The business is organized around one central theme: structural heart disease, specifically what happens when the valves in your heart stop working properly. The aortic valve is the most commonly affected, and Edwards dominates the transcatheter aortic valve replacement market, known as TAVR, with its SAPIEN platform. They also make surgical valves like the Inspiris Resilia for patients who still need open heart procedures.
And what changed recently is that EW sold its critical care division to Becton Dickinson in September 2024 for $4.2 billion. That division made hemodynamic monitoring equipment, important technology, but not structural heart. After that sale, Edwards is now a pure-play structural heart company. Every dollar of revenue comes from valves and valve-related procedures.
That divestiture was a major strategic pivot. Investors had to decide whether narrowing the business was value-creating or value-destroying. The answer was complicated. The stock has been range-bound since the deal closed, and this earnings report is really the first substantive opportunity to assess whether the pure-play thesis is delivering the growth and margin profile that management promised.
Now, what makes Edwards so interesting is the market they operate in. TAVR, transcatheter aortic valve replacement, is one of the fastest-growing procedure categories in all of medicine. An aging global population means more patients with calcified, failing aortic valves. Clinical guidelines have expanded indications to younger and lower-risk patients, and the total addressable market for transcatheter heart valves globally is estimated to exceed $10 billion by 2030.
And on top of TAVR, they are investing heavily in the next frontier: transcatheter mitral and tricuspid valve therapy. TMVR and TTVR are the procedures being developed for the mitral and tricuspid valves, which are structurally more complex than the aortic valve and have historically been harder to treat without surgery. Edwards has the Pascal platform for this market, and the patient population is estimated to be 3 times larger than aortic disease. That is the long-term bet.
Competitive moat is worth talking about here. Edwards holds more than 50% U.S. market share in TAVR with the SAPIEN 3 Ultra Resilia system. That comes from 20-plus years of clinical evidence, more than 250,000 patient implants, and a delivery system that catheterization labs have trained on and become expert in. Switching to a competitor valve means retraining, revalidating, and potentially disrupting procedural flow. That is an enormous sticky factor.
The Resilia tissue technology, their proprietary anti-calcification treatment on the valve leaflets, is a key differentiator. It extends the durability of the biological valve material, which matters enormously for younger patients who may need a valve to last 15 to 20 years. That is not easy to replicate. Medtronic's core valve Evolute and Boston Scientific's Accurate Neo2 are both competing in TAVR, but neither has matched Edwards on the depth of long-term outcome data that gets guidelines committees comfortable recommending a procedure to a 65-year-old.
Now let us talk about the person running all of this. Bernard Zovigian became CEO in January 2023. He is an internal promotion. He joined Edwards back in 2007 and spent years in senior commercial and operational roles across Europe and the US before taking the top job. He was deeply involved in Edwards' international expansion and the surgical structural heart business.
His handling of the critical care divestiture was generally well received. He got $4.2 billion for a business that many on the street viewed as non-core, executed the deal efficiently, and returned a portion of the proceeds to shareholders through buybacks. The central test ahead is executing on two simultaneous commercialization bets, maintaining TAVR dominance while building Pascal into a real second commercial platform. That is a significant operational challenge.
He is regarded as technically credible with real product knowledge, not a pure finance or M&A executive. That matters in a company where every major decision involves clinical evidence strategy, physician relationships, and regulatory pathways. The Q4 2025 EPS miss happened on his watch, and how he addresses it this quarter will tell investors a lot about whether he can manage the cost side of this transition.
All right, let us dig into the financials. Edwards Lifesciences is trading at $81.22 per share, giving it a market cap of about $47.2 billion. The stock has a 52-week range of $69.84 to $87.89, so we are in the upper half of that range heading into this report.
What does the valuation look like on the traditional metrics?
It is premium across the board. Price to earnings on a trailing basis is 44 times. Price to sales is 7.8 times. Price to book is 4.6 times. EV to EBITDA is approximately 33 times. These are not cheap multiples. This is a stock where the market is pricing in several years of strong execution. For context, the broader medical device sector typically trades at 20 to 25 times earnings.
So you are paying a significant premium relative to the group.
You are. And that premium is justified only if structural heart volumes continue to grow at double-digit rates, Pascal gains commercial traction, and operating margins expand toward 30% or better. Any shortfall on any of those three legs, and you have a multiple compression problem on top of an earnings miss. And that is historically a painful combination for this stock.
Now let us talk about the revenue picture. Trailing 12-month revenue is approximately $6.1 billion. That is about 9.5% year-over-year growth, which reflects the first full year of the post-critical care structure. Quarterly revenue has been climbing steadily. $1.41 billion in Q1 2025, $1.53 billion in Q2, $1.55 billion in Q3, and $1.57 billion in Q4. And the Q1 2026 print that just came out shows $1.62 billion.
That is a solid beat versus the $160 billion consensus estimate. And the trend line is what matters. EW has been delivering consistent sequential revenue growth throughout 2025, which is exactly what you want to see from a pure-play structural heart thesis. The question is always whether the growth is procedure volume-driven or pricing-driven, and EW has historically grown through a mix of both.
Margins. What does the profitability look like?
The gross margin profile is exceptional. 78% gross margin is best in class for a medical device company. Operating margin on a trailing basis is approximately 27%. Net margin is 17.6%. EBITDA margin runs around 23% on the FMP calculation, though I would caution that the EBITDA number includes some unusual items from the critical care transition. The underlying structural heart operating margin trend is the number to watch.
And the EPS story is a bit nuanced.
It is. Q4 25 delivered 58 cents in adjusted EPS versus estimates of 62 cents, a meaningful miss that the street reacted to negatively. It happened despite a revenue beat, which means the miss was all cost side. Elevated R&D spending on the next TAVR generation and Pascal commercialization, plus commercial infrastructure build-out. Q1 2026 shows 74 adjusted EPS versus the 72 estimate, a small but clean beat that suggests the cost dynamic is at least stabilizing.
Cash flow is strong.
Very. Operating cash flow for fiscal 2025 was approximately $1.6 billion. Free cash flow was approximately $1.3 billion after capital expenditures. The company does not pay a dividend, which is unusual for a company this size in this sector, but they have been putting capital to work in buybacks. And the balance sheet carries a net cash position of $2.2 billion. That is after the partial return of critical care proceeds to shareholders. Financial health is strong. This is a company that generates significant cash and has essentially no leverage risk.
Overall, how would you characterize Edwards Lifesciences' financial health?
Overall, Edwards Lifesciences' financial health is strong. Exceptional margins, strong free cash flow generation, net cash on the balance sheet, and a revenue growth trajectory that validates the pure-play structural heart thesis. The only near-term blemish is the Q4 2025 EPS miss on costs, which is the central question this Q1 report is answering.
So let us talk about what Wall Street thinks. The analyst consensus is buy, with 15 buy ratings, 6 holds, and just 1 sell across 22 analysts covering the stock. The consensus price target is $97, implying about 19% upside from current levels. The range is wide, low target of $78, high of $125, which tells you there's genuine disagreement about whether the premium multiple is sustainable.
There have been some meaningful grade changes worth flagging. JP Morgan upgraded EW from neutral to overweight in December 2025, citing structural heart as a durable long-cycle growth market and viewing the critical care divestiture as value-creating. TD Cowen upgraded from hold to buy in January 2026, pointing to accelerating TAVR procedure volume data. And Truist Securities maintained a hold through their Q4 2025 update, wanting to see Pascal milestones before getting more constructive on the valuation.
So the upgrades are tracking the structural heart volume data, and the holds are anchored on valuation and execution risk.
Exactly. The Q4 2025 earnings print, the 58-cent EPS miss despite a revenue beat, was the main driver of recent debate. Q1 2026 showing 74 cents versus 72 cents estimated is a constructive sign that the cost absorption is easing. Revenue of $1.62 billion versus $160 billion estimated is a clean beat. Both together should give the bullish analysts more ammunition and take some pressure off the holds.
What is the options market telling us?
Put-call ratio heading into earnings was 0.82, which is modestly bullish. IV percentile was around 45, slightly above average, which makes sense given the Q4 EPS miss set up elevated uncertainty. Call concentration at the $85 to $87 strikes through May suggests buyers positioned for a clear beat. Post-earnings, expect IV to compress back toward the 30th percentile as uncertainty resolves.
All right, let us lay out the bull case for Edwards Lifesciences. What does the optimistic scenario look like?
The bull case starts with TAVR procedure volume compounding. As clinical guidelines expand to younger patients, and TAVR becomes the default over surgical aortic valve replacement in most risk categories, Edwards captures incrementally more procedures annually at $10,000 to $12,000 of revenue per implant. The math on that is powerful over a 5-year window. And EW's 50+% market share means it captures the majority of that volume expansion.
And beyond TAVR,
Pascal is the optionality that the market may be undervaluing. Mitral and tricuspid valve disease affects a patient population estimated at 3 times the size of the aortic cohort. TAVR took about 10 years from first commercial approval to widespread adoption. If Pascal follows a similar trajectory, even a compressed version of it, the incremental revenue opportunity is multiple billions of dollars annually by the early 2030s. That is not in the current consensus numbers at anything close to full probability.
what else drives the bull case?
The international underpenetration story. TAVR adoption rates in Europe and Asia remain well below U.S. levels. EW is investing in market development in Japan, China, and emerging European markets where healthcare systems are just beginning to build catheterization lab infrastructure for these procedures. That global runway is a multi-decade organic growth driver that does not require any new product approvals, just the diffusion of an already proven technology into new geographies.
And the $2.2 billion net cash balance sheet.
Right. That gives management the ability to do a strategic acquisition in structural heart or adjacent cardiovascular markets if the right opportunity emerges. A well-priced tuck-in that accelerates Pascal or adds a complementary therapy would be viewed as value-creating at current cost of capital. The dry powder is there.
Now the bear case.
The core bear argument is valuation. 44 times earnings and 7.8 times sales is a lot to pay for any company, and the Q4 2025 EPS miss is a reminder that even a small deviation from expectations causes disproportionate multiple compression. EW has a history of sharp drawdowns when guidance resets. The stock fell more than 25% in a single session in July 2024 when it cut full-year guidance. At these multiples, the margin of safety is thin.
What about on the competitive side?
Medtronic and Boston Scientific are not standing still. Both have next-generation TAVR systems in development or early commercial launch. If clinical data from a competitor valve shows equivalence or superiority in a specific patient subgroup, particularly younger, lower-risk patients who are the fastest-growing TAVR cohort, it could shift cardiologist preference and erode EW's market share meaningfully. EW's dominance has been built on clinical evidence leadership, and that leadership position requires continuous investment to maintain.
And the Pascal uncertainty.
TMVR and TTVR have proven harder to commercialize than anyone projected. The valve anatomy in the mitral and tricuspid positions is far more complex than the aortic, and clinical outcomes data from early Pascal procedures has been mixed compared to surgical repair in some subgroups. If Pascal adoption lags milestones, or if the FDA or international regulators require additional trial data before broadening indications, the next major growth vector for EW is deferred, and the stock is priced as if it is not. That is the bear case in a sentence.
And the cost structure issue from Q4.
That is the near-term version. If R&D and commercial spending for Pascal and next-gen TAVR continues to grow faster than revenue, the margin expansion story that bulls are counting on does not materialize on the timeline expected. At 44 times earnings, a sustained margin compression story would force a re-rating.
Let us see how Edwards stacks up against its closest peers. How does EW compare to Boston Scientific and Medtronic in valuation terms?
EW trades at a significant premium. Boston Scientific, a direct TAVR competitor with accurate Neo2 and a much broader cardiovascular portfolio including the FARAPULSE PFA system, trades at about 8.5 times sales and 28 times EV to EBITDA. BSX is actually growing revenue faster than EW at over 11%, and the market gives it credit for that. Medtronic trades at only 3.5 times sales and 14 times EV to EBITDA, reflecting its much slower growth profile and portfolio complexity spanning spine, neuromodulation, and diabetes.
So EW is right in the middle on PS relative to those two, but at a premium on EV to EBITDA.
Exactly. The EV to EBITDA gap versus BSX reflects EW's pure-play structural heart premium. The market is willing to pay more for a company that is entirely concentrated in the highest growth segment of cardiovascular devices. Stryker, which is more of an orthopedics and surgical company with minimal cardiovascular exposure, trades at 5 times sales and 25 times EV to EBITDA. A useful anchor for what medtech multiples look like without the TAVR growth premium baked in.
So if you believe in the TAVR and Pascal growth algorithm, EW's premium can be justified. If you're skeptical, you can find cheaper medtech exposure.
That is a clean framing. The pure play premium is the price of admission for the structural heart thesis.
What about insider activity? Any signals there?
Insider trading disclosure data was limited for this period. No significant open market purchases or sales were disclosed. What we do know is that the company deployed approximately $259 million in share repurchases during recent quarters, which is a meaningful form of insider confidence expressed through corporate capital allocation rather than individual transactions. Management is not selling aggressively, which is a neutral to modestly positive signal.
And looking ahead, what are the key catalysts and risks to watch in the coming quarters?
On the catalyst side, watch the Pascal center count and procedure volume trajectory. That is the leading indicator for TMVR becoming a real revenue contributor. Watch TAVR organic growth on a constant currency basis. And watch any announcement of a tuck-in acquisition, which would signal management confidence in deploying the $2.2 billion cash balance. On the risk side, watch competitor valve trial data from Medtronic and BSX. Watch for any reimbursement policy changes in the EU or Japan that could affect international procedure economics. and watch the quarterly SG&A and R&D expense trends for signs of cost normalization.
Let us bring it all together. Q1 2026 is a genuinely important quarter for Edwards Lifesciences. Revenue beat at $162 billion versus $160 billion estimated. EPS beat at 74 versus 72 estimated. After the Q4 2025 miss, investors needed to see both: a clean revenue number and evidence that the cost structure is not running out of control.
The structural heart thesis is intact. TAVR procedure volumes are growing, the Pascal platform is in active commercialization, the balance sheet has $2.2 billion in net cash, and the premium valuation, while demanding, reflects a business that has no close competitors in its core market and a potential second act in mitral and tricuspid that could be transformative over the next decade.
The bear case rests on valuation, Pascal execution uncertainty, and the memory of what happened to this stock in July 2024 when guidance was cut. Those risks are real. A 44 times earnings multiple built on pure-play structural heart concentration means any stumble has an amplified downside effect.
The key metric I would watch going forward is structural heart organic growth rate on a constant currency basis. If EW sustains 10% or better organic growth through 2026, the premium is defensible. If it slips towards 7 or 8%, either from TAVR saturation or competitive pressure, the re-rating risk is real. And on the Pascal front, any update on U.S. TMVR active implanting centers crossing 300 would be a meaningful milestone, signaling commercial momentum.
Also, watch operating margin guidance for the full year. The Q4 2025 miss was cost-driven, and analysts need a path toward 28 to 30% operating margins to justify holding the multiple. If management guides for margin inflection in the second half of 2026, the bull case gains real traction.
This is a company that has earned its premium through 2 decades of clinical evidence leadership and consistent execution. The structural heart revolution it helped create is still in the middle innings globally. Whether the multiple is sustainable depends on whether the next chapter, Pascal, can build on that legacy.
And on that note, let us leave you with a quote from CEO Bernard Zovighian.
We are creating the future of structural heart therapy, and we believe we are just beginning to scratch the surface of the patient opportunity ahead of us. That is the confidence of a company that invented the TAVR market and believes it can do it again in mitral and tricuspid.
That is going to do it for this episode of Charged Alpha, Edwards Lifesciences, ticker EW, Q1 2026 earnings deep dive. If you found this useful, subscribe wherever you listen to podcasts. And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I am Hudson Thomas.
And I am Lana Chen. This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street